Imagine a company that promised to change how the world works. Offices filled with energy, slogans about community, and a vision so big that investors believed it could never fail. Now, imagine one of the world's most powerful investment giants pouring billions into that dream, convinced it was funding the future. This is the story of SoftBank and WeWork, and the biggest lesson about what can go wrong when vision blinds judgment. At the center of this story is belief. SoftBank, led by Masayoshi Son, believed deeply in founders with bold ideas. The Vision Fund was created to back companies that could dominate entire industries. When SoftBank looked at WeWork, it didn't just see office spaces. It saw a global platform that could redefine how people live and work. That belief became so strong that basic questions slowly stopped being asked. WeWork's core business was simple. It leased office buildings long-term, redesigned them, and rented them out short-term to startups and freelancers. But it was marketed as a technology company, not a real estate business. This difference mattered. Tech companies scale fast with low costs. Real estate companies grow slowly and carry heavy risks. SoftBank accepted the tech narrative without challenging it enough, and that was the first mistake. The second mistake was ignoring fundamentals. WeWork was losing massive amounts of money every year. Its growth was powered by cash, not profits. Instead of fixing the business model, more money was injected to keep expansion going. This created an illusion of success. Valuations kept rising, not because the company was healthier, but because investors were afraid of missing out. Then there was the founder problem. Adam Neumann was charismatic, confident, and visionary, but he was also reckless. Personal decisions blurred with company decisions. Conflicts of interest were ignored because the company was growing fast. SoftBank didn't just invest in WeWork, it invested emotionally in Neumann himself. When investors stopped questioning leadership, they stopped protecting their capital. The turning point came when WeWork tried to go public. For the first time, the numbers were exposed to the world. Losses, governance issues, and unrealistic projections were no longer hidden behind hype. Public investors were not convinced. The valuation collapsed almost overnight. What was once talked about as a $100 billion company suddenly struggled to justify a fraction of that value. SoftBank was trapped. Having invested so much money, walking away was impossible. This is called the sunk cost fallacy. Instead of cutting losses early, more money was used to rescue the investment. Billions were spent not to grow, but to survive. The original dream was gone, replaced by damage control. The biggest lesson from SoftBank and WeWork is that vision without discipline is dangerous. Big ideas are important, but they must be supported by strong fundamentals. Growth is meaningless if it is not sustainable. Valuation is not reality. Cash flow and governance are. Another key lesson is concentration risk. SoftBank placed an enormous bet on a single company and a single founder. When that bet failed, the damage was massive. Diversification exists for a reason, whether you're investing billions or just your own savings. Finally, this story teaches that storytelling is not the same as value creation. A powerful narrative can attract money, media, and attention, but only a solid business can survive scrutiny. Investors must learn to separate inspiration from execution. SoftBank and WeWork will always be remembered as one of the most dramatic investment failures of modern times. Not because money was lost, but because the warning signs were visible long before the collapse. The true cost of this mistake was not just billions of dollars, but the reminder that even the smartest investors can fail when belief replaces analysis.